Hello, everyone. Thank you for joining today's webinar discussing the tax reform effects on manufacturing and distribution. Today's program will be presented by Dave Poillucci, partner in Withum's Manufacturing, Distribution, and Logistics Services Group, Ian Taylor, manager in Withum's Manufacturing, Distribution, and Logistics Services Group, and Chaya Siegfried, leader of Withum's International Business Tax Group. Before we begin, I have a few housekeeping notes. Material for today's presentation can be found in the toolbar located on the right side of your screen. Also at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey for today's webinar. Please take a moment to complete it. It is our best way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Dave, Ian, and Chaya.
Thanks, Matt, for the introduction, and thanks everyone for joining us during your lunchtime. Today we'll be discussing the Tax Cuts and Jobs Acts, but before we begin, let's take a quick look at our agenda. We'll start off by discussing how the Tax Act impacted C corporations, flow-throughs, and individuals, and also the impacts on depreciation, tax accounting methods, interest expense, all relative to the manufacturing and distribution industry. As well, we'll be touching upon some international tax topics. Just want to note there, as with many provisions, and specifically with international, we could probably spend the entire day talking about those implications. So today we're going to attempt to give you a broad overview of how these provisions impact manufacturing and distribution businesses. And then finally, we'll finish off by touching upon some incentives. So the new bill was signed into law, providing benefits aimed at stimulating domestic manufacturing and provided an overhaul to our tax system that will enable U.S. companies to be more competitive in a global marketplace. While tax reform was publicized as simplification, which may be the case for the factory worker, as you will see from our discussion today, the new tax law created more complexity for the factory owner. As you all have heard in the media, the tax bill was rushed through Congress using the budget reconciliation process. This was done specifically to comply with the Byrd Rule, which allowed the Republicans to pass the bill without a single Democratic vote, as long as the deficit did not increase significantly beyond a 10-year term. So the legislative process resulted in some seemingly arbitrary provisions as Republicans tried to fit the increase of the budget into a $1.5 trillion box. With that, we're anticipating a technical corrections bill and new regulations issued to provide needed guidance that is currently lacking in the new law. Any further legislation will likely require bipartisan support and have to go through the normal legislative process, so stay tuned and be patient. On the slide in front of you, we'll take a look at a few key points regarding the new tax law. So President Trump signed the Tax Cuts and Jobs Act into law on December 22nd, 2017. Unless otherwise noted, the changes are otherwise noted in our presentation today. The changes are effective on January 1st, 2018. Most individual tax changes expire December 31st, 2025. As I indicated, Republicans needed to get through the reconciliation process and couldn't affect our budget for more than that 10-year term. So this was one way to manage that process by having the individual tax provisions expire. Expect additional complications to further arise from state and local taxes because many states automatically adopt federal changes and others may adopt them in part or in whole at some future point in time. So now we'll look at some corporate provisions that changed in the new tax law. Prior to 2017, with C corporations, we had a marginal rate system that maxed out at 35%. Now, as most of you are aware, under the new tax law, we have a 21% flat corporate tax rate. For fiscal year corporations that straddle the 1/1/2018 effective date, will have to prorate their tax rate between the old law and the new law. The new Tax Act eliminates the domestic production activities deduction, which was a benefit that most manufacturing companies were able to take advantage of under prior law. And the new law also repeals the alternative minimum tax. As you will note through our presentation today, we've sprinkled in a couple of planning tips to consider as we talk about the new tax law. So our first planning tip is under these favorable corporate changes, there's a potential for pass-throughs to consider converting to a C corporation. This planning tip is not to imply that every pass-through should convert their business to a C corporation, but certainly there are certain scenarios out there where it would make sense for a C to transition or convert to a C corp to take advantage of the lower 21% corporate tax rate. The new tax law had some sweeping changes on the use of net operating losses. Pre-2008 net operating losses that are going to be used in years 2018 and going forward can be fully utilized. However, net operating losses that are incurred or generated post-2018 have a limit moving forward of 80% of taxable income for the current year. And there's no carrybacks of post-2018 NOLs. So with that limitation, Congress provided somewhat of relief because of the limits to allow taxpayers to carry forward NOLs indefinitely.
And with that, we have our first polling question. How is your business currently organized? C corporation, S corporation, partnership, sole proprietorship?
All right, so we have just about 96% of everybody voted, so we'll close the polls. So as you can see, we've got 37% are C Corps, 37% so equally split between C Corps and S Corps, 19% for partnerships, and 7% sole proprietors. So with that, we'll move on to the qualified business income deduction, and I'll turn it over to Ian Taylor.
Thanks, Dave. Appreciate it. So nice to see a large portion of you guys are flow-through entities, which is what this next section is going to apply to. So the qualified business income deduction was placed in service so that flow-through entities could keep on par with C Corps after the lower C corporation tax rate. Entities eligible for this deduction are partnerships, S Corps, or sole proprietorships. Additionally, the actual deduction is taken on the individual's 1040. At the last minute, also, trusts and estates were allowed to have this deduction as well for the income they get from flow-through entities. What's not clear at the moment, though, as we'll wait for the guidance, electing small business trusts that own S corporations, there's typically a number of caveats with those trust types, so we'll see if they still qualify for this deduction, but we can't give a final answer on that just yet. So what is the deduction? It's 20% on the qualified business income amount of the activity. It's determined on an activity-by-activity basis, and there are three key terms or determinations we have to make around this deduction. First, we have to determine the nature of the business, if it qualifies, the type of income generated by the business, and third, there are some numerical limitations that must be applied. So first, nature of the business. Generally, any business qualifies for the deduction as long as it's not a specified service business. The new code section refers back to section 202 or 1202, which has been around since the early 1990s, but has not been very well litigated or defined. If you read through the definition on the screen, some of the key terms I want to point out are consulting activities, brokerage services, or any trade or business where the principal asset is the reputation or skill of one or more of its employees. So if your business falls into one of those categories, you might not be eligible for this deduction. And the terms like consulting and brokerage are pretty broad terms, so we'll have to wait for further guidance from the IRS. Like I said earlier, there hasn't been much guidance so far because the Section 1202 has not been widely used, so there's not many law cases on it at the moment. And our plan tip for this is cracking or packing, depending on what further guidance provides. And what that means is if you have a manufacturing activity and there is some small portion of that that is a specified service business, the IRS may come out with a de minimis rule that says that de minimis amount of service business activity will not taint the rest of the income, and the deduction can be taken on the whole amount. If the IRS does the flip side of that and says that any kind of specified service business, as de minimis as it may be, has to be excluded from the calculation, then we might want to consider cracking the businesses apart and forming two different entities.
Yeah, and I'd just like to point out, so I mean, clearly when looking at manufacturing companies, certainly not a specified service business, and for manufacturing concerns structured as a pass-through, certainly will be eligible for the qualified business income deduction. In terms of distribution and logistics companies, at this point, our interpretation, we feel they fall outside the definition of a specified service business and also should qualify for the qualified business income deduction. As Ian mentioned, there's unfortunately at this point in time a lot of uncertainty surrounding the new law, specifically this definition. So we'll need to wait for additional guidance from the IRS.
Yep, thanks, Dave. So moving on, after we have our nature of business, we have to look at the type of income generated by that business. Once again, kind of by exclusion, all income is generally considered qualified business income unless excluded. Excluded amounts are interest income, not applicable to the trade or business, dividend income, long-term capital gains, short-term capital gains, and any activity not effectively connected with the U.S. Most of those items in the list have preferential tax rates, which is why they're already excluded from that list. Moving on, the final determination is numerical. The deduction is limited to 50% of the taxpayer's allocable share of W-2 wages. Additionally, you could, if that income does not apply to, or the limit does not apply to you, you could use 25% of taxable wages plus 2.5% of qualified property of the business. That second calculation is really related to real estate companies because they have no wages. In the essence of time, we'll skip over the defining W-2 wages, but it's pretty clear that it has to be on a payroll tax return. The 2.5% of basis limitation, qualified property there has to be depreciable, so you can't use land or inventory. The benefit there, though, is that you don't use the adjusted basis. It's the original cost basis before depreciation. And if you have a short life asset, like a 5-year piece of machinery, for the purpose of this calculation, you use a 10-year life instead, so that asset stays on for longer for this calculation. Our plan tip here, evaluate owner compensation. You're going to want as much as possible of the income to be on box 1 of the Schedule K1, meaning regular operating income for the business. You want as little as possible to be owner's compensation, because owner's comp is taxed at the highest marginal rate of 39, whereas the qualified business income is a 20% deduction against it. So a quick example, assuming we have maximum tax rates, even though income's only $100, we have a manufacturer who's eligible for the domestic production activities deduction, and now in the future, the qualified business income deduction. So under the old law, we had $100 of income. We took a 9% DPAD on that. The taxable income of $91 is multiplied by the top maximum rate and gives you an effective tax rate of roughly 36%. In the new law, we replaced that 9% DPAD with a 20% QBI deduction, and then apply a lower 37% rate, the effective tax rate is 29.6. So a 6% savings. If under the old law you weren't eligible for DPAD, your tax rate would have been 39.6, so you would experience a complete 10% reduction in the tax rate, which is a very nice benefit considering that C Corp rate went down 14. Dave will talk about C versus S comparisons. Moving on, excess business loss limitation. Before this new law, there were three what I call hurdles to get over in order to take a loss on a business. There was a basis limitation, an at-risk limitation, as well as if you're a passive investor, the passive activity loss limitations. Now there's a fourth level there in this excess business loss. You can only deduct a business loss to the extent of $500,000 on a joint return or $250,000 on a single filer. And this is the aggregate of all your business losses on your 1040. Any disallowed loss gets carried over to the future years as an NOL, which is limited under the new rules to 80% of taxable income, and there are no carrybacks. So if you had a loss and under old law, you might be able to get a refund because you can get prior tax refunded. Under the new law, you got to wait a while before you can get your refund. And now before I go back to Dave with individual tax, we're going to go on to our next polling question.
All right. Our next polling question is, did you prepay any of your 2018 property taxes to maximize your 2017 SALT deduction? Yes, first 2 quarters. Yes, first quarter only. No, town did not allow prepayment. No, subject to AMT.
I'd expect in our neck of the woods here, a lot of people will be subject to AMT. So I'd be surprised if that number doesn't jump up pretty high.
We have 90% of our audience voted. We'll just give it a couple more seconds before we close out the polls.
Remember, if you want CPE, you have to vote in at least 3 of the 4 polls.
Okay, we just reached 93. We'll close out the poll. So as you can see, we have 25% did prepay the first 2 quarters, 7% prepaid the first quarter only, and 30% no, town did not allow the prepayment, and 36%, as Ian indicated, the highest grouping of participants were subject to AMT. Just want to note, just for a point of clarification on there, while the prepayment did allow for a federal deduction of your 2018 real estate taxes in 2017, for New Jersey residents, those prepayment of the 2018 taxes need to be deducted on your New Jersey return for 2018, not 2017. So New Jersey just come out with a clarification on that, so I wanted to make sure everybody was aware. So with that, we'll move on to an overview of how the Tax Cut and Jobs Act impacted individual rates and deductions. So for 2017 and prior, we had a 36, if I can get the right percentage out, I'd be much better off here. Sorry about that. So we had a 39.6 maximum rate with a standard deduction of $12,700 and an exemption of $4,050. Under the new act, we now have a maximum individual rate of 37%. Standard deduction was doubled to $24,000 and no exemption. So that's kind of, I think what the Republican Party was looking at when they're publicizing simplification. That $24,000 exemption is going to take a lot of our lower income taxpayers out of a complicated return and a much simpler filing. The act also limits the state and local tax deduction, that's for real estate taxes and state income taxes, to $10,000 annually. So as a planning tip here, residency planning is more important than ever, with the loss of the state tax deduction. As a firm, we've received a lot of inquiries, a number of calls from our clients with the loss of the SALT deduction in the new tax act. That kind of pushed them over the edge for clients that were considering moving out of New Jersey. So looking for us for advice and making that move and planning to ensure that New Jersey doesn't come back and say you're still considered a resident. So on to the next slide, we'll just take a high-level look at, we've got the comparison of the single and joint tax brackets for 2017, prior law, 2018, new law in front of you. A couple of points to note. With the new law, there's just an overall broadening of the brackets so that more of individual income is taxed at the lower rates. The top marginal rates kick in under the new law for single taxpayers at $500,000 at 37%, and for married taxpayers filing joint at $600,000 is where you hit the 37% rate. The new law also aligned the single and married brackets so as not to impose that so-called marriage penalty. So you notice in the 2018 single column, as compared to the joint brackets are pretty much double the single brackets, with the exception of the top marginal bracket. That's where the marriage penalty is imposed at $500,000 and comparatively to $600,000. And one of the original versions of the bill, the top threshold for married taxpayers was at $1 million. But again, as we had to get the bill into that $1.5 trillion box, married taxpayers lost that benefit of the higher tax bracket. On to the next slide. Just give a high-level comparison of the top federal rates. As you can see, the corporate tax rate dropped 14%, which is a significant decrease. When looking at individual rates, wages dropped from 39 point, well, in this presentation here, we included the 0.9% Medicare tax on earned income. So it's 40.5% dropped to 37.9%, so that decrease of 22.6%. Capital gains and qualified dividend rates remain the same. Interest, rents, and royalties, again, dropped by 2.6%. Looking at income from flow-through entities, straight across the board, assuming the flow-through entity, and we believe most of our audience participations are going to qualify as manufacturers or distributors for the qualified business income deduction as a flow-through, whether you're structured as an S-corp, a partnership, or you have passive owners, you should realize a 10% reduction in your tax rates, assuming you don't run into any of the many limitations that are imposed under the law. So I want to take a moment here to look at some of the changes in depreciation, more notably the bonus depreciation and Section 179 depreciation. So this actually, the changes in the Tax Act for bonus depreciation were retroactive to 2017. Many of our clients aren't aware of that, so we wanted to highlight that and emphasize that here in this timetable. So from 1/1 to 9/27/2017, we have 50% bonus depreciation available, and then from 9/28/17 through 12/31/2017 and beyond, we have 100%. I don't know why that says 22 there. Sorry about the error. But we have 100% bonus depreciation after September 28, 2017. And then that bonus depreciation starts to begin to phase out from 2023 through 2027. So as you can see, below the timetable in 2018, Section 179 limit was increased to $1 million. So as that bonus depreciation amount phases out, the 179 deduction at $1 million will become more favorable. That's permanent in the law, and also has a built-in inflation adjustment. And also notable under the law, the new tax law, bonus depreciation now applies to used property. In the past, it only applied to newly acquired property. And then some notable points regarding Section 179, roofs, HVAC, fire protection, and alarm systems and security systems are now eligible for 179. So that would be another reason not to use bonus depreciation in this case, because these types of property are not eligible for bonus, but will be eligible for 179. And then a planning tip here, consider the interaction of accelerated depreciation methods with the qualified business income deduction and interest limitations. So with the qualified business income deduction, we want to try to maximize that deduction to the extent we can, because that results in a permanent tax benefit. While we try to accelerate depreciation, just keeping in mind that depreciation is a timing difference. So if we don't get it immediately in year one, we will get it over time.
The qualified business income deduction is scheduled to phase out after 2025. So unless you believe that Congress will extend that deduction, it looks like it's only going to be around for a few years. So you want to really maximize the amount of income in that time period when it's eligible for that deduction, which is kind of counterintuitive, but it all depends on how you think that law will be extended or sunset.
Okay, so now taking a look at a qualified improvement property, the law, the new Tax Act, kind of eased the requirements for this type of property. There's no longer has to be done pursuant to a lease. The related party rules are relaxed, and the requirement that the improvement be made to a property that's more than 3 years old was also relaxed.
So if you remember, or maybe you don't, but before this new qualified improvement property definition came out, there was 3 separate definitions. There was qualified leasehold property, qualified retail, and qualified restaurant property. Those 3 definitions were combined into this one, and it broadens the scope of what's eligible for a shortened recovery period under depreciation. And with that, we'll keep moving on. I am a member of the Withum Accounting Methods team, so I'm happy to talk about this next section. For a long time, the IRS has wanted everyone to be on the accrual method of accounting. Over time, they've had a few easements to that, and they allowed like a $5 million exception or a $10 million exception. Well, now all those exceptions are being increased to a $25 million threshold. So as long as your gross receipts are below $25 million, you can be on the cash method even as a C corporation. You can reduce the types of costs included in inventory, meaning the timing of the deduction for inventory is not changed, but you only have to include direct materials. All the overhead can be stripped out and deducted as a current expense. And finally, you can avoid Section 263A, the UNICAP rules, which require you to capitalize additional costs for tax purpose that may not be capitalized for book purpose. And all these will be automatic changes. We have to wait for guidance to come out with the exact way to do that, but we've been told it's going to be all automatic. And the nice thing about these adjustments, if it's a favorable adjustment, you can deduct it all during the year of change. And if it's an unfavorable, let's say you really want to go to cash method, but your payables are greater than your receivables, it's going to be an unfavorable adjustment to conform to the new law. That'll be spread over a 4-year period, which is a nice benefit. And I'll show you that on the next slide, a quick example. Assuming we have a manufacturer with these items in their balance sheet, inventory of 750, which includes 400 of direct material, in other words, 350 of overhead. We've got AR of $1 million, AP of $1.2 million, and prior year capitalized cost of $240,000. So if we're looking at these adjustments to go from the old accrual method with these items in it to a cash method, the cash conversion adjustment is based on AR and AP. If we take out of income our AR and take out of our deductions our AP, we're left with an unfavorable $200,000 adjustment, which we can spread over 4 years. The 263A adjustment or UNICAP, we just completely remove the capitalized cost, and we get a favorable $240,000 deduction. And finally, on the inventory, if we strip out those overhead costs of $350, we get an adjustment for that as well. So you can see here to the right of that, totals in 2018, you can have a total adjustment of $540,000 favorable. And if you chose to only do the UNICAP and inventory adjustment and stay on the accrual method, you can remove that cash conversion adjustment as well and save a little more money. It's not 100% clear whether you can do these independently under the new law. However, based on rev procedures from old law, it's pretty clear you can kind of pick and choose which ones you want to do. So assuming the old law kind of carries forward in the same theme, you can pick and choose. Next, in one of the prior planning tips, Dave mentioned an interest expense limitation, so I'll talk about that now. This kind of existed for worldwide organizations, and they're referred to as the earnings strippings rules, but now it's been made applicable to all U.S. taxpayers. And what it does is limit the amount of interest expense. If you're going to get upfront depreciation on a piece of equipment, it's not fair that you get the interest deduction on that as well. So the IRS wanted to make you pay for it somehow, and that's through this interest expense limitation. You can only deduct interest expense up to 30% of adjusted taxable income. The adjustments to get to adjusted income are you add back the interest expense itself, depreciation, amortization, net operating losses, as well as a few other small adjustments. So unless you've got a lot of interest expense, chances are those add backs will increase your taxable income to a level where the 30% limit is not met. I will note that depreciation and amortization add backs are only around for tax years beginning before 2022. At that point in time, those add backs go away, so really you only have interest expense add back. If you're below $25 million of gross receipts, similar to the other methods of accounting, this interest expense limitation does not apply. Any interest that is limited gets to carry forward indefinitely. So now on to our third polling question.
Our third polling question is, do you own the real estate related to your manufacturing distribution operation? Yes, no,
Okay, so we've hit 97% of the vote, and we will close the poll. So 72% of you said no.
All right, well, for the 28% that did say yes, you'll want to pay attention to the next slide, which regarding the interest expense limitation. The $25 million threshold applies on an aggregate basis. So if you have related entities, meaning you have common ownership, the gross receipts of your manufacturing business may force your real estate business to be subject to this interest expense limitation. However, there is some relief. If you are in the real estate trade or business, you can elect out of the interest expense limitation. However, there are some consequences. You must use the alternative depreciation system for your non-residential and qualified improvement property. That means that your recovery period is typically a little bit longer, not by too much. For non-residential property, you're going from 39 years to 40, but on the qualified improvement property, your recovery period goes from 15 to 20. And that's especially important because that property will not be eligible for bonus depreciation. So there is an unfortunate add back for that. And next item to talk about, meals and entertainment. Like Dave said, there's a $1.5 trillion box that this bill had to fit into. In order to make that work, you get some quirky tax law out of it, and this is one of those items. So business meals, you take a client out for lunch, that's still a 50% deduction. Where the change occurs is now entertainment. If you're taking a client out to, you know, a nice Giants game or something like that, the entertainment portion is going to be 0% deductible. So what it also means in your accounting department is that they will have to adjust and probably create a new account for how you are going to track this type of expense, because typically meals and entertainment are combined. Final note on the page, meals provided for the convenience of the employer. If your employer pays for a de minimis fringe benefit for like going to the cafeteria in your building and they pay for part of that, that's no longer 100% deductible. It's going to be 50% deductible. Next, we have Chaya talking about international tax.
Yeah, thanks, Dan. So the international tax landscape has undergone a monumental shift. There are lots of changes, definitely no simplification here. The biggest, or the one that's most touted, is the shift from a worldwide system of taxation to a territorial system of taxation. And what that means is, in the past, a U.S. taxpayer that had a foreign subsidiary, the earnings in the foreign subsidiary were taxed in the local country, and then when the earnings were repatriated to the U.S., they were subject to U.S. tax. Going forward, and this is for 1/1/18 and forward, in a similar scenario, the earnings would be taxed in a foreign subsidiary, and then when repatriated, they would not be subject to U.S. tax again at that point. Now, we'll get to in a couple of minutes why there's a huge asterisk near the word territorial system. I actually heard someone describe it as a full inclusion system masquerading as a territorial system, because this territorial system, number one, is only available for C Corp. So only if the U.S. shareholder is a C Corp do you get to take a deduction for dividends repatriated to the U.S. So what happens is, once the earnings are taxed in the local country, when they're brought back to the U.S., there's 100% dividend receipt deduction, but only for C Corp shareholders. Now, in addition to that, we'll talk about in just a couple minutes Subpart F and GILTI, where even a U.S. C Corp shareholder would be subject to the tax in the foreign subsidiary. So moving from the worldwide system to the territorial system, there are billions and trillions of dollars of earnings that were earned in the worldwide system that are sitting in the foreign subsidiaries that are deferred for U.S. tax purposes, haven't been subject to tax. And so the transition from the worldwide to the territorial system, we have this one-time deemed repatriation event, which is deemed to have occurred during 2017. And what this is basically any U.S. shareholder in a CFC, a controlled foreign corporation, or foreign corporation that has 50% or more U.S. shareholders, more than 50% U.S. shareholder, or a foreign subsidiary of a U.S. C Corp where the U.S. C Corp owns 10% or more, is deemed to have repatriated all of the previously untaxed earnings that were sitting in the foreign entity. So there's a big deemed dividend inclusion in the U.S. This inclusion will be taxed at a rate of 15.5% or 8%, depending on whether the foreign entity has liquid assets or illiquid assets. So to the extent that there are liquid assets in the foreign entity, the dividend will be taxed at a 15.5% rate, and then any dividend that exceeds whatever foreign liquid assets are on the balance sheet will be taxed at an 8% rate. The tax is due with your extension for your 2017 return, but taxpayers do have an election to pay this tax over 8 years. So you have to compute the tax for 2017 on this repatriation, and then you have the ability to kind of pay the tax that's due for 17 over 8 years, but only the tax that relates to this. If you are a S corporation shareholder and the S corporation owns a CFC, you can elect to defer paying the tax on this repatriation indefinitely until indefinitely until a triggering event occurs. So a triggering event for these purposes would be you sold the stock of your S Corp, or if the S Corp liquidated most of its business. So for some, this is an opportunity to bring back previously untaxed earnings that are sitting in a foreign entity at a reduced rate, but this is mandatory, so this is not an option. So this is something that some taxpayers have been waiting for, but for those that do not want to do it, they do not have an option. It's mandatory. So jumping to some changes to the foreign tax credit rules, historically we've had a 902 or an indirect credit for C Corps that owned foreign corporations. If they own 10% or more of foreign corporations, they could get a credit for the local country taxes paid by the foreign subsidiary. In certain instances, they would still get that credit, but instead of using a pooling approach where you look at, the accumulated earnings and the accumulated taxes paid on those, the pool of taxes paid on those earnings, it's now going to be a year-by-year computation. So you would only be allowed a foreign tax credit for the foreign taxes paid on the particular bucket of income that you're bringing back, and not for foreign taxes that you've paid over the years in a pooling approach. Another change to the foreign tax credit relates to the overall domestic loss rules. And historically, what those rules are is if you have a domestic loss and foreign income in a given year, you can track the domestic loss that reduced your ability to take a foreign tax credit. And then in a year when you have domestic source income, you can recharacterize that income as foreign source so that you would have more foreign source income to be allowed to take the foreign tax credit. The ODL in the past, you were only allowed to restate up to 50% of your domestic income, but the new rule allows you to restate up to 100%. A big one in the manufacturing, for those manufacturing in the U.S., historically, for foreign tax credit purposes, if you manufactured something in the U.S. and then sold it with title transferring outside of the U.S., the income from that sale of good would source 50% to the U.S. and 50% foreign source. The new rule changes that sourcing so that if product is manufactured in the U.S. and then sold by the same taxpayer, it is 100% U.S. source, regardless of where title transfers. So this may limit some foreign tax credit capacity for U.S.-based manufacturers. Okay, so now we have, moving on to the global intangible low tax income. So this is similar to Subpart F in that this is a new type of income that if it's earned by a CFC, it is deemed repatriated in the year that it's earned. At a very high level, we don't really have time to go into it in detail. Basically, just to give you the policy behind this rule is there was this perception that U.S. taxpayers were moving their IP outside of the U.S. in an effort to move the high levels of income that relate to IP outside of the U.S. tax base. And so this law, the Global Intangible Low Tax Income provision, was implemented to try to put a stop to that. And basically what it says, we're not tracing your intangible income, but we're saying a CFC, we look at the CFC, we look at the fixed assets, we're going to give you a free pass on 10% of those fixed assets as income. So we're going to say on your fixed assets, you can earn a 10% rate of return every year. And then any income that a CFC earns that's on top of that the 10% fixed rate of return is going to be this GILTI income. And if it's GILTI income, it's deemed repatriated in the year that it's earned. So if if you have a manufacturing plant offshore, you may still have a GILTI inclusion, even though it's not intangible assets because you're only allowed a rate of return of 10% on your fixed assets. So if your CFC, if you look at your CFC fixed assets, and you look at 10% of that, if your income exceeds the 10% of your fixed assets, you may have a GILTI inclusion. Now, GILTI is taxed, if it's a C Corp shareholder in the U.S., the GILTI tax is 10.5% on that income, and you are allowed a foreign tax credit of 80%. So, you know, there should be some offset. On the other hand, if you're an individual that owns a CFC, or if your U.S. entity is a flow-through structure, the tax that you're paying on GILTI is the highest individual rate, so it could be as high as 37%. And keep in mind, you do not get a foreign tax credit offset. So what that means is if you're in like the UK and you have GILTI, you'd be paying 19% UK tax. And then if you're a flow-through in the US at the individual level, you're going to be paying 37% tax on that income again, without a foreign tax credit offset. Okay. One more quick provision for U.S.-based company C Corp. If they have foreign-derived intangible income, there's a 13.125% beneficial rate of tax on that income. And just in the interest of time, I'm not going to go into detail on what that is. There's also a base erosion anti-abuse tax, or a B tax. This one applies only to U.S. taxpayers that have $500 million or more in U.S. source revenue, and it's alternative minimum tax concept that relates to related party payments. So if you're below that $500 million of annual revenue, then this is not something that you would need to think about. We have here just a couple other international changes. We're not going to go through them. I don't think we have time for that. But if you have any questions, you can definitely reach out. We can address those with you. Turning it back over to Dave.
Thanks, Chaya. So we're going to take a quick look at the Research and Development Tax Credit. This federal credit was retained in its current form under the new tax law. Just one notable change, that R&D expenses must be capitalized and amortized over a 5-year period instead of fully expensed, effective for tax years beginning after 12/31/2020. It's always hard to say once you get past 20. So anyway, we'll go to the next polling question.
Does your business currently take advantage of the federal R&D credit? Yes or no?
Okay, we're about 93% of our participants voted, so we'll close the polling. So 46% yes, and 54% said no. So for those that claim the credit, it's great that you're taking advantage of this robust tax incentive. For those who don't take advantage of the credit, Withum does have an entire R&D tax credit team, and we're happy to help you. So with that, just real quickly on a domestic production activities deduction, not going to spend a lot of time. This was repealed and somewhat replaced by the qualified business income deduction. So next, I'd like to take a few minutes to talk about C Corp versus pass-through. The 21% corporate rate, has created a lot of buzz, and many businesses are questioning their current organizational structure. The decision to convert to a C Corp requires planning and careful analysis. So with that, it requires so much analysis that we've dedicated an entire separate webinar to this topic. So today we're just going to kind of cover it at a high level. And the slide depicts some of the tax and non-tax considerations to consider when converting your pass-through to a C Corp. So under non-tax considerations, you'll need to update legal agreements, operating partnership agreements, shareholder agreements, and the like. There may be issues depending on the industry sector you're serving, with regulatory compliance based on entity type. You have to consider the overall impact on any current pension plans that your business has. Some tax considerations. There's a whole host of advantages and disadvantages of being a C corporation. Obviously, with the C corp tax regime, even though the new tax law changed the tax rates, the old conventional thinking of single tax versus double tax still exists. So that's still an issue when companies want to make distributions of accumulated earnings out of a C corporation. We have to consider exit strategy and the tax cost of asset sales versus stock sales. And then at the state tax level, many considerations. State taxes often get overlooked, but do come into play when making this analysis. So the next slide just covers a couple of scenarios as to when might a C corp versus a pass-through make sense. So if you have a manufacturing distribution business that's in a high growth stage, needs retain a lot of cash to invest into the business, certainly as a C corp you can reinvest those profits at a much lower tax cost. As a business that perhaps maybe an ancillary service business that is not eligible for the 20% QBI deduction, as a pass-through may make sense to be a C corp. In terms of exit strategies, if you can determine with certainty, it's hard to say. Nobody has a crystal ball. You never know when a strategic buyer may come knocking on your door and what type of sales structure that may facilitate. But if you know you're going to sell as a stock sale, or if you intend on, in a closely held business, you intend on transferring the business to the next generation through gifting or holding until death and transferring as part of your estate, there may be advantages there to being a C corp. Companies that have minimum capital requirements imposed by regulatory or bank covenants may make sense, where they can't strip a lot of profits out of the company. There's some state tax planning advantages as a C corp, notably for manufacturers and distributors of tangible goods, and then there's some benefits available in the C corp regime, as Chaya had pointed out, when there's ownership in controlled foreign corporations. So with that, we're going to move on to the questions. Appreciate everybody's participation today. We're running a little short on time, so we want to try to get everybody out of here in the next 5 minutes. We'll have Matt read the questions that were submitted, and we'll address them as best as we can.
Thank you so much. Does blended tax mean that any corporation having fiscal year ending March, the marginal tax rate will be 30.75%, 75% of 34%, plus 25% of 21%?
So the calculation is done based on a number of days in each period where the tax is effective. If I believe off the top of my head, for a March year end, the effective tax rate will be 31.5%.
Okay. And keep in mind that is just during the transitional period.
Yep, and that might have some quirky consequences on your tax provision for your financial statements. Certainly reach out for assistance with that portion of it when it comes time for your provision.
Regarding personal exemption, I was under the impression that the personal exemption was reduced from 4,000 to 600, not 0. Can you confirm?
We can certainly confirm that the personal exemption was repealed and eliminated, is not available, is replaced with just a higher standard deduction for singles at $12,700, I think it was, and $24,000 for married. What I think you're referring to in terms of the $600 is the child tax credit. Perhaps under the old law, there was a $600 child tax credit, now increased to $2,000, and there's some refundable portions of that as well. So I think perhaps that's what that question is alluding to.
And that is all the questions we've received thus far. If you have anything else, please send it within the next couple of moments.
Alternatively, on the next slide, the final slide, is our contact information. So if anything crosses your mind afterward, or you want to pick our brains on something, feel free. Here's our contact phone numbers and email addresses.
Thank you, everybody, for participating today, and enjoy the rest of your afternoon.
And also, please remember to take a moment to complete the online survey, and thank you for joining us.